Welcome to Money Talks. I'm your scribe, Jennifer Powell. It's Money Monday. And so today we're going to be talking about Trump's new tax changes that just went into effect for this past tax season of 2018, your 2018 tax returns. So remember that the purpose of this channel is that we're going to talk about whatever affects our income, whatever affects our pockets, and ways that we can help increase our income or prevent income liability. And tax liability is something that we deal with on a yearly basis and for the rest of our lives, because there's nothing certain in life but taxes and death.
So understand that taxes is actually revenue to the government. So in 1913, Congress ratified the 16th Amendment to state that Congress shall have the power to lay and collect taxes on income from whatever source derived.
So we're going to talk about these new tax changes and how it affected our income this year. Did it increase your tax refund? Did it increase your tax liability? Did it decrease your refund or tax liability? We're going to get into that and why, and also talk about the predictions of what is to come for the new tax changes.
It was the night before Christmas, and all through the house not a creature was stirring, not even a mouse. And then Trump's Santa appeared, who said he was here to bring us all holiday cheer. And then he said with glee and fun, cutting taxes is going to be my beautiful Christmas gift to everyone. Merry Christmas to all, he said as he flew out of sight. Was it really a Christmas gift to you? We're going to find out tonight.
Whenever there are new changes to the tax code, we need to make sure that our withholdings from our paycheck apply or are applicable to these new changes. And so we need to make sure, especially if you think that these new changes are going to bring you a tax cut, then you need to make sure that you're having enough taxes withheld from your paycheck. Whenever there's a changes to, in this instance, we had a change to our deductions, our rates, the brackets changed, as well as the personal exemption no longer exists. And so we need to make sure that our withholdings are reflecting those changes and that we're getting enough withheld from our checks, or we're not getting too much withheld from our paychecks for tax purposes. And so the IRS actually recommends that you do this on a pretty regular basis, where you visit the IRS website, you visit their IRS withholding calculator just to make sure that you are getting enough taken out of your paycheck, or are you getting too little taken out of your paychecks. Use that calculator to determine that and make the changes to your W-4 as necessary. You can go by your HR department and request the change to your W-4.
So to better understand how these new tax changes affect our tax liability or refund, we need to understand tax as an equation. First, you take your gross income minus any adjustments, and that equals your adjusted gross income, or your AGI. And then you take your AGI, subtract from that your standard or itemized deduction, and your new tax deduction, the qualified business income deduction, and that equals your taxable income. Then you take your taxable income and you multiply that by the tax rate, and this equates to your tax liability, and will show how the tax rates and brackets have changed to help out your tax liability. And then from your tax liability, you're going to subtract any credits that you qualify for and any of the taxes that you paid this year, and that equals either your tax liability or a refund. And now I'm just showing you how the equation fits into your actual tax form 1040. As you can see at the top, we have our gross income, where we report our adjustments, our deductions, where our taxable income is reported, where our credits are deducted from, where our taxes are deducted from, and where at the end of our form 1040 we get our tax liability or refund. So amongst all the changes that were made in the 2018 tax year was that the 1040 actually was cut short. And so it's not as long as it used to be. And in the place of that, we have these schedules now, schedules 1 through 5 to report additional income or additional adjustments. Your adjustments are actually reported on Schedule 1. And I've highlighted here for you the adjustments unto which were changed by the Trump tax changes.
Adjustments. We know adjustments decreases our gross income. So the less income you make, the less taxes you owe, right? And so we want to take as many adjustments as possible to get a good AGI, or adjusted gross income, that will essentially reduce our tax liability. And so some of the changes that have been made to the adjustments that you can take this year as of Trump's new tax changes in 2018 was alimony, for one. So prior to the Trump tax changes, any alimony payments made to someone, the person receiving the alimony payments had to include those payments in their gross income. And the person who paid the alimony payments could deduct those payments from their gross income. But that's no longer a rule, and you are not able to either decrease your income from alimony payments or increase your income from alimony payments. Another tax change to adjustments was that prior to Trump tax changes, you used to be able to take a deduction for relocating to a new city for a job. Me, I just relocated to Atlanta for a job. I would have been able to take the money, the expenses that I paid to relocate, and deduct my gross income with those expenses. That is no longer the case now. You can no longer take a deduction for relocating to a new city, only if it's for military purposes. So those are some of the changes in our adjustment. Let's talk about deductions. What changed in the deduction portion of our tax equation? Well, this year, the standard deduction has increased, doubled in fact. So I have a good feeling most people took their standard deduction this year, but you may choose to take either your standard deduction or your itemized deduction. And so the standard deduction is a fixed rate, of course, and it's based upon the status to which you are filing. So if you're filing head of household, single, married, will depend on your standard deduction amount that you should take. Or you can choose to itemize your deductions. Now, a lot of people used to itemize their deductions because they found that they got a bigger deduction from itemizing as opposed to taking the standard. This year, I'm not sure if that's going to be the case because the standard deduction has doubled, and there has been a couple of changes to the itemized deduction. So here are the changes that you can see for the standard deduction, the comparison from 2017 to 2018, how the new Trump tax changes nearly doubled the standard deduction for taxpayers of 2018. Couple of changes to the itemized deductions. So for the medical and dental deduction that you received, you used to could take a deduction for any medical or dental expense in excess of 7.5% of your AGI. Now it has increased to 10% of your AGI, so which essentially means that you have to have paid more dental and medical expenses to take the deduction, because now it has to be at least 10% of your AGI as opposed to 7.5% of your AGI. Another change to the itemized deduction is the mortgage interest. It's capped at $750,000 as opposed to $1 million. And then for your personal and casualty losses, that will be suspended for these new tax changes for the years that these changes will be in effect, which are 2018 to 2025. So you can no longer take a personal casualty loss unless the loss was caused by what the federal government considered a national disaster area. So itemized deductions are reported on a Schedule A and attached to your 1040. Highlighted are the parts of the itemized deductions onto which Trump taxes changes affected. So another Trump tax change that went into effect that changes the calculation of our AGIs, that we're no longer able to subtract a personal exemption. You used to be able to subtract this personal exemption for yourself and your dependents, but that's no longer the case anymore. So in comes your qualified business income deduction. As opposed to taking a personal exemption, if you have a business, you're able to take an additional deduction from your AGI for having a business. Now let's talk about this new deduction, the qualified business income deduction. So this deduction came into effect because the C corporations had a big tax rate deduction from 35% to 21%. And the Congress didn't want the middleman to feel left out, the sole proprietorships, the S corps, and the partnerships to feel left out. And so to curb their high tax liability, which is still at 37%, they gave them these new deductions. And it's for anyone who conducts a business, you're allowed this deduction. Except for certain service businesses, but for the most part, just about any business is allowed this deduction.
Just a little more information about the qualified business income deduction. You can find more information on the irs.gov website, but the deduction is essentially 20% of your qualified business income. So like I said, there's more to it, and there's more information on the website if you need more detail.
Okay. Now let's talk about the equation part that deals with the tax rate. And so your tax rate is based on what tax bracket you're in. And so for this year, the tax brackets and the tax rates has changed significantly, as you can see, which means that you won't be taxed higher with the more income you receive. So the way it's set up, for instance, take someone with head of household, for instance, as opposed to being taxed at 15% for this amount of income being made, you will be taxed at this percent, a lower percentage for that same amount of income. So the tax rates and the tax brackets have been cut and switched significantly. Let's take a look. So we can see here how the tax rates have changed. It went from 15% being the next highest, from 10% to 12% being the next highest, to the 39% decreasing all the way to 37%. We can see how the amount of income, for instance, a single taxpayer one, if you made $9,000 past $9,525, it immediately boost you into a 12% tax rate, as opposed to last year, if you made past $9,325, it boosted you into a 15% tax rate. So we can see how the tax rate and the brackets is actually beneficial to the taxpayer as of 2018. Let's talk about credits. Now, credits are better than deductions because deductions depend on your tax rate and your tax bracket. Credits, however, are mostly used to incentivize something, a policy. For instance, I give you a tax credit for clean energy. If you use clean energy, or if you drove a Prius all year, you get a tax credit, an energy tax credit. So the credits are used in these cases to help incite policies. But some of the tax credits, one of the tax credits that changed significantly this year for the Donald Trump's tax changes, President Trump's tax changes, was the child tax credit, which increased from $1,000 to $2,000 per child. So instead of getting $1,000 per child in the prior years, you get $2,000 per child, which is a good credit. So now that we've seen the changes into effect with the adjustments, the changes to deductions, and the changes to credits, and we know that what all was changed in those parts of the equation, let's put it into practical use. Let's play a little game. So we're going to have a woman, and her name is Cindy. And Cindy is a single mother of 3 children. She makes $45,000 a year. She just moved to New York. And her moving expenses was $1,500. And we know that's not even practical to move to New York, but hers was $1,500, and she received alimony payments this year in a total amount of $2,000. Let's calculate what her tax liability or refund would be with the new Trump tax changes as opposed to if she would have filed this in 2017. So let's play the game.
Okay, so just to recap here, we have Cindy, who's going to file head of household. She has 3 kids. She makes $45,000 a year. She received $2,000 in alimony, and she used $1,500 to move to New York.
So we're going to take this extremely simplified tax situation and put it into our equation to see if the Trump taxes actually helped Cindy or if they actually hurt Cindy. So in this case, we can see that the Trump tax changes actually helped Cindy. Her refund was $2,954 as opposed to $675. And this is basically more so due to the Child Credit Act increasing from $1,000 to $2,000. But as you can see, the taxable income actually hurt her taxable income. Taxable income is actually $27,000 as opposed to $19,950, and that's because the personal exemption no longer existed anymore, and those adjustments were no longer available to her anymore in 2018. But even after all of those changes, she still came out with a bigger refund with the Trump tax changes.